Hi, this is Gus Faucher. I had technical issues, but I'm on. Hi, this is Gus. Sorry, I had some technical issues, but I should be okay now.
Well, good morning, everybody, and welcome to our economic update and family business succession planning with our sponsor and partner, PNC. We're pleased to have an update. As you know, we have Jean Crescente, who's PNC's expert on succession planning, and of course, PNC's chief economist, Gus Faucher, who will give a quick update, economic update, which is his third to the IEE community this year. In addition to PNC, I'd like to thank all of our other sponsors, Meyer, Unkovic and Scott, UPS, UPMC Health Plan, AT&T, Cohen & Company, Wilkie & Associates, the Net Experts, and C-Level. We couldn't do these kind of programs without your support. And I'd also like to make a big shout out to Patrick Maley on the PNC team for help putting this together today. I'd like to remind everyone of our upcoming programs. On September 22nd, we have the Success Cadence with Dave Mattson. Dave is the national CEO for Sandler. And we are actually going to do that program in an outdoor venue, a tented outdoor venue in Bellicera in Canonsburg. And it will also be live streamed and recorded for those who cannot make it in person. So we will be wearing masks and socially distanced, and it will be good to take advantage of this beautiful September weather. In October, we have Extreme Ownership and How U.S. Navy SEALs Lead and Win with Flynn Cochran. That's on October 22nd. And of course, that one will also be offered virtual, and we will update you if we can also have an in-person option for that. In November, on November 12th, we have Harvard Business School's family business expert, Christina Wing, presenting multi-generational success. And that will also be virtual, and we'll keep everybody updated on the other format as things progress. Now, I'll hand it over to Peter Vaccaro, who's the Wealth Management Market Leader for PNC Wealth Management. Thank you. This is Bob again. We're having a slight technical difficulty with Peter. Hold on for one moment. While we're waiting for Peter, we'll just go ahead right into our economic update with Gus Faucher, Chief Economist for PNC. Gus? All right, third time's the charm. While we figure out Gus's technical difficulties, we're going to start with Jean Crescente, PNC's family succession expert. Jean?
Rob, I'm on. So I
Gus?
think we're good there. Sorry about that. Yep, sorry about that.
Okay. All right, Gus,
Okay.
go ahead.
Sorry about the technical issues, everyone, and thank you for staying patient with the way things are going. So obviously we've spoken a couple of times over the past few months. The situation now is very different from where we stood in the spring. So, let's head back to the beginning of 2020 when I initially spoke to the IEE at the beginning of the year. Everything looked solid for the U.S. economy. The economic fundamentals were good. And then obviously the pandemic came along and we saw a very, severe slowing in the U.S. economy, roughly from February to April. There's a group called the National Bureau of Economic Research. They date recessions and expansions in the United States, and they announced that the U.S. economy, economic activity reached a peak in February of this year, and then the economy experienced a severe contraction. Now, they have not said that contraction is over, but it looks like the U.S. economy is expanding once again, and that we are in the initial stages of a recovery. That doesn't mean that the economy is good. We are still in a very, very deep hole, but we are seeing the economy start to grow again. The downturn that we experienced was incredibly severe. So between in March and April, the U.S. economy lost more than 22 million jobs. We saw the unemployment rate rise from 3.5% in February to 14.7% in April. That was the highest unemployment rate that we've had in the history of that series, which goes back to just after World War II. We got numbers for GDP, gross domestic product, and they show that the U.S. economy actually contracted more than 10% between the end of 2019 and the second quarter of 2020. To put that in perspective, during the Great Recession a decade or so ago, we saw the U.S. economy contract about 4% over a year and a half. So this was a much steeper contraction in the economy over a much shorter period of time. And this is a very different recession from what we've seen previously. Previous recessions were caused by imbalances in the economy. This one was caused by the steps taken to combat the coronavirus pandemic, people staying at home, people purchasing less, and so forth. And so we saw a very, very severe contraction in the U.S. economy. So we saw sharp declines in consumer spending and business investment. And so we've experienced a very steep contraction in the U.S. economy. As I mentioned, the good news is that things are starting to turn around. So as states have been gradually lifting restrictions on economic activity, we've seen consumer spending come back. We've seen retail sales come back. That's actually above where it was before where we were before the recession started. We've seen housing starts come back, and so we are in the early stages of what should be a strong economic recovery. We're also getting support from the federal government, so that we've had a number of stimulus packages that provided more than $2 trillion in support to the economy. We had aid to small and medium-sized businesses, including the Paycheck Protection Program, which offered low-interest loans to small businesses that turned into grants if they stayed open and kept their workers. We had one-time stimulus payments to many households. We had expanded and extended unemployment insurance benefits, including an extra $600 per week. And we've actually seen household income increase during the time that the economy was in recession, which is simply unprecedented to have a big increase in household income. So as states have allowed more activity, that's allowed consumers to boost their spending, and that's contributed to that rebound that we are seeing in the U.S. economy. So since things bottomed out in the spring, the economy has added, about 10.5 million jobs. So we've added back a little less than 1/2 of the jobs that we lost during the downturn. The unemployment rate fell from 14.7% in April. It was 8.4% in August, still extremely high, still more than double where we were before the recession, but certainly a noticeable improvement in the labor market. Housing starts are up, auto sales are up, consumer spending is rising. And so we are in the early stages of an economic recovery. That being said, I think things are going to get more difficult for the recovery from here on out, and I think that growth is going to be a bit slower, in the fourth quarter of 2020 and then throughout 2021 than it was in the third quarter now. Couple of reasons why. I mean, we've gotten a lot of the benefits from those businesses that have reopened, and consumers, to some extent, things slowly getting back to normal, and so that's allowed for many businesses to reopen quickly. But we're going to see some businesses that are going to try to make it with reduced capacity, but simply won't be able to do it. The other thing is that there are some businesses that simply will not be able to open in the current environment. So you think about the entertainment industry, movie theaters, sporting events, concerts, that type of thing. It's simply that business model simply isn't viable in the near term given the pandemic. Similarly, airlines, there's a structurally lower level of demand for air travel. There's a structurally lower level of demand for hotels now. And it's going to take a vaccine or much more extensive mitigation efforts before we see those industries return to normal. And so that's going to take a period of years for those industries to return to normal. And that means that the recovery as it progresses will see significantly slower growth later this year and in 2021 than what we're seeing right now in the third quarter. The other reason for concern is that the stimulus impact is fading. So people got those one-time stimulus benefits in the spring. The bonus unemployment insurance benefits have expired. They're trying to rework those and perhaps may come up with a substitute for those, but many households have reduced income now compared to where they were 2 or 3 months ago. And so that means that it's going to be more difficult for them to increase their spending, and I would expect consumer spending growth to be significantly weaker going forward than it was in the early stages of the recovery. And so I think that although certainly I'm encouraged by the way things are going, it is going to take a long time for the economy to recover fully from get us back to where we were in February. The unemployment rate, as I mentioned, was about 8.4% in August. I would expect that it's going to be somewhere, between 7.5% and 8% at the end of this year. We're adding about, 1.4, 1.5 million jobs a month. I would expect the job growth is going to slow to below 1 million a year by the end of 2020. Becomes more difficult, and we see some businesses close permanently and in other industries forced to restructure. Real GDP growth looks like it's going to come in somewhere between 25 and 30% annualized in the third quarter, but it's going to slow to the single digits beyond that. So I think, in terms of GDP, output of goods and services in the United States, I think we're not likely to return to where we were at the end of 2019 until the end of 2021, so a period of a couple of years. I think that, employment, the return to the previous level peak of employment, which was in February. I think that's not likely to happen until sometime in early 2022. So it is going to be a very difficult road back. I do expect that we will see continued low interest rates as the Federal Reserve keeps interest rates extremely low in order to support the economic expansion. I am concerned about the lack of stimulus that the Congress is having difficulty passing an additional stimulus program. And then I'm also discouraged by the fact that we really do not seem to have a handle on the pandemic and that we do not have it contained. Our track record in the U.S. is not nearly as good as it's been in other developed economies. So that's certainly very discouraging, and that is going to make it more difficult to see a return to strong economic activity. In terms of the Pittsburgh area, because Pennsylvania has been more aggressive than many other states, we did see a more significant downturn in Pennsylvania and in the Pittsburgh metropolitan area than what we've seen in other states. That being said, Pittsburgh is less exposed to many of the industries that are going to see long-term damage from the pandemic. Pittsburgh, a lot of healthcare, a lot of financial services, business and professional services. Those industries are less likely to suffer structural damage from the downturn. And so I do expect that the recovery in the Pittsburgh metropolitan area will be stronger than the recovery in the rest of the United States. But still, even in Pittsburgh, it's going to take a significantly longer time. It's going to take a significant amount of time for the economy to recover and to get back where we were at the beginning of 2020. And with that, I will pass it back to Rob.
Great, thanks, Gus. Now I'm going to hand it to Peter Vaccaro, who's Wealth Management Banking.
Here we go again. Bob, can you hear me?
We can hear you loud and clear.
All right, so sorry, having many technical difficulties today, and happy to be here today to join all of you. I lead private banking for wealth management at PNC, and I just want to thank all of you for joining today's seminar. I hope you enjoyed Gus's presentation. It's very timely. These are extraordinary times, and I'm sure many of you have a lot of interest in what he has to say, and I'm sure you will with what Gene is going to cover. PNC has been a proud sponsor of the IEE since its inception over 25 years ago. We share many of the same values, and I can't say enough about the work that Bob Stein and his team do with the Institute and all of the folks that participate. It is absolutely extraordinary, and we're proud to be a part of the organization. To the point that many of our employees participate in many of the seminars that many of you have seen. And actually, we have a few of them participating today. I really hope that you enjoy today's program. It's very timely. I know Gus touched on a lot of topics. Management Wealth Strategy Market Manager in Pittsburgh. We'll talk about some things that I'm sure many of you will have interest in, and that is succession planning for your business, which is particularly really want to thank all of you for participating today. I want to thank all of you for those of you that are PNC clients as well. And again, I want to applaud Bob Stein and the entire Institute for the great work that they do. So at this point, I'm going to turn it over to Gene Crescente, the Wealth Strategy Market Manager for PNC Wealth Management in Pittsburgh. Gene, I'll turn it over to you. Thank you.
Okay, great. Just checking, Bob, you can hear me?
Loud and clear.
Awesome. All right, well, fingers crossed, we're going to jump in to talk about business transition planning right now. As Pete mentioned, my name is Gene Crescente. I run the wealth strategy component of our wealth management offering in Western Pennsylvania. So the people I work with cover everything from Erie down to the West Virginia border and over to State College. So hopefully some of you are PNC clients and you've run into us once or twice. What we're going to focus in on today is talking about the basics of business transition, give you some of the ideas of what's available out there to you, talk about some of the process, and hopefully plant some seeds that you want to develop further so we can really get started on this. Because I will tell you, business transition doesn't happen. You have to plan for it. You have to put it in perspective, and it has to meet the needs of the business, your family, and yourself. And so these are all the things that we work with when we're talking with our business planning partners. So what is it? And to reiterate what I was just saying, it's just good business strategy. Good businesses have an eye on their exit as they're operating day to day. It doesn't mean they're looking to pull the trigger, but they're ready for it if circumstances arise that they can take advantage of it. Because it's all about positioning the business and shareholders, your family, to maximize value. You never know when that's going to happen. I mean, going back 8 months ago, lots of private equity firms and other strategic buyers were running around with very large numbers that they were throwing around. Businesses were selling for very large multiples historically. And the businesses that were ready to pounce on that really reaped a lot of extra value than they were expecting. So it pays to keep all of this in mind and have an eye on this at all times. So when we talk about transition processing, we analyze, we evaluate, we educate business owners, obviously. We talk about where their business is today, what their alternatives are, where they could take the business in the future. And again, planned and unplanned. Everybody wants a planned, hopefully, transition. But again, if somebody shows up, and I'm going to show my age here, if Ed McMahon shows up at your door with the big old giant check, you might want to take a good hard look at that. So we're going to look at the pros and cons of each option when we're working with our clients and the implications it has on the shareholders and the family members and the business. I mean, most business owners are going to involve in some kind of transition, a business that's going to be left behind. And a lot of you have strong feelings about the business. So it really helps to keep an eye on how does the business operate if I'm not there? Have we set it up for success? If you have, that generally is going to lead to a much better price if you're going to sell the thing. And the whole idea is educate the business owner, get them ready to make a transition, figure out what they need for themselves, what their family needs, what the business needs. If you take care of all three of those areas, chances are you're going to have a more successful transition. So when we do this, we kind of focus in on 5 questions as we go through our process. So what is our process, or what are these questions regarding it? So how should you transition the business? Now, there's a lot of things that happen before we get to this, but obviously figuring out the right way to transition the business is important. And we're going to go through the steps that are available to you in a transition. And when, now, hopefully, as we were just saying, that you've kept an eye on your transition activities so that you're ready if something very nice comes along. But otherwise, you want to plan for it, especially if you're planning on leaving the business in some form to family. You want to have your ducks in a row and the business being set up for a successful transition. Obviously, value is a key component in the whole process here. We've got a couple things that we work with that give us not only quantitative analyses of the business. In other words, we can hang a number, based on the rest of the industry on the business, but qualitative pieces too, which really help sharpen and concentrate what we're looking at in terms of, can we get an excess return over what is expected? We'll go into that a little bit later too. Talking about you personally, we've got stuff here talking about who benefits from the wealth generated from your business. Well, hopefully you and your family. if we've done it right and we've got everything in order. But that takes a little bit of work on, doing a cash flow for yourself, thinking about how we should look at your estate planning. And again, what can the business provide and how can it provide it? Is it all going to be one shot? Is it going to be paid out over time? There are things that go along with this. And I guess the number 5 here is kind of the more important thing about talking about a planned transition of being ready. How do you design this to make it happen? And what do I need in the business to be able to move when I feel ready? What do I need on my personal side to move when I feel ready? And who are the people to help me get there? And we're going to talk some more about all this as we move along here. Okay. So why now? Why are we talking about business transition now? Again, as you're going to hear me say this 100 times, if not more today, I think we should be thinking about a business transition as part of the ongoing strategic operations of the business, because again, you never know when an opportunity will come along. But now there's some other things in the pipeline which are really pushing the issue here. You can see we got a picture here, the age wave, 10 trillion in wealth. Okay, this is basically what we're looking at with the baby boomers here. And there's going to be, over the next 25 years, a fairly large transition of wealth from the baby boomer generation down to the millennials and below. I'm in Gen X, we don't get any of that. So what are we talking about specifically with businesses? Well, you can see on the right there, there's about 4.5 million small businesses in the United States, depending on how you want to define them. 60% of that number are owned by baby boomers. And over 3 million of those businesses and baby boomers are going to have an exit activity within the next 10 years. So there's a big transition coming up. There's going to be a lot of activity around business transition. And if you don't take the time to get your business and your personal life set up properly, you're not going to reap full value from the transition. You can actually see below here, we got a couple more things to keep in mind. Just saying I'm going to put my business up for sale is great, but it's not a cure-all. Only 30% of businesses that go to market actually sell. The ones that sell are the ones that put in the work, and the business is turnkey to the next person, and it's really got a nice niche, and everything is ready to go. You can see if you're saying, I'm not going to sell it, I'm just going to keep it in the family. Well, only 30% of family-owned businesses make it to the second generation, and only 12% survive to the third. It's a process. We need to have everybody in the right place, trained up, and doing the right activities to keep the business running. So these are some of the things we talk about. So what are the things we look at when with a business owner to say, I really could use some, succession help now? We call them tells. All right, so if you come out and say, I want to transition my business in the next 3 to 5 years, okay, great. That first thing on the board here, we note that there's a short-ish time frame to really organize things properly to get the right price. The business, and this is very common with business owners, that the business turns out to being a very large percentage of their total net worth. You've probably heard the statistic that for most people, their house is the largest component of their net worth. But like a house, the business isn't necessarily liquid. It takes a lot to sell a house. It takes a lot more to sell a business to reap out the gains that have been accrued in there. If you've got an owner that's in their late 50s or more, if there are multiple shareholders, if you've got children, some who are in the business, some who are not in the business, there needs to be a plan about that, not only for the business, but on the estate side too. If you've got a business, and this was certainly something we were seeing at least through 2019, where it was becoming extraordinarily difficult to attract and retain people, general employees, but also key employees. There was a lot of movement being created in the market because of shortages of talent wherein people were getting 25, 30% increases in compensation to jump ship. Obviously, if you have a small business and you've got a key person and they jump ship, there's a lot more effort that it's going to take to fix that in a smaller business than, say, a very large one, because there's probably not as deep a bench, if any. So we got to think about that. If you're already thinking that you've got succession planning, liquidity, or asset protection, and you talked about it, we, as part of PNC, we have lots of bankers that deal with businesses on a day-to-day basis, and they'll come to me and say, hey, I've spoken with my client and they actually brought this up out of the blue. Should we be doing something more? Of course, the answer is yes, but if you're actually evidencing your fears or frustrations about where you're at out loud to various people, I think that's a big tell. Here's the last one here, and this requires taking a pretty good look in the mirror. But if you can look at your business and say, I'm doing it right, we're doing great, everything's running just the way we think we can, but there's competition coming in that has an exponential ability to underprice us or outplay us here. So we have to really think, what's the best thing for us? Do we grow to catch up? Do we acquire someone to catch up? Or is the right thing to sell because we just don't have the oomph behind us anymore? That's a tough conversation. There's a lot of work that goes into figuring out what's the right move there. This is where your team of advisors really comes into play. Okay, so let's take a look at what we call value drivers. So we've been through, okay, what are the tells? So what are the value drivers here? What are the things that we think are based on what you've got going in your business? What are the things that are going to make your business sell for more or be worth more than an average business in your field? There are lots of these. I just got a few on the screen here, but there are some things that, as we're working with clients, that we can bring up and we can work on to help improve the valuation by focusing on the value drivers. So if you've got a business where the owner manages talented managers and is focused on strategic endeavors, that's great. That business is generally going to be worth more than a business where everything flows through the owner. It's all micromanaged and nobody can do anything without getting the okay from the owner. Because if somebody's coming in to buy that business, in the first case, they've got a team that's already there running the day-to-day business. That's great. In the second place, now they have to go build that team or integrate it. And it's just a lot harder to get value when everything has to run through the owner. If you got a business where employees, especially key employees, have their average age in their mid 40s or even low 50s, that's worth more to a buyer where everybody's in the high 50s, early 60s, right? Because what's the first thing that's going to happen if somebody buys the business? Okay, I have a lot of people to replace in short order, especially key people. So a younger workforce is probably worth more to a buyer. If you got a business where your products, whatever your products are, whether you make something physical or you provide a service, if that's branded and managed as a brand, and that is an actual term of art, just calling something, naming something you do or something you make, by a special name doesn't necessarily make it a brand. It's really an effort to manage to a brand. But if you're managing brands as part of your business, that's worth more to someone than where the products are undifferentiated. A business where your employees are cross-trained and flexible, that's worth more than where everybody knows they're one thing and they don't do anything else. A business where clients are structured, so there are multiple people that have the relationship contact, is worth more where everything flows through one or two people. And this is really on the sales side. Not that you want to have everybody and their brother in front of the clients, but realistically, you're going to have people that are going to transition. It's a lot better for a client relationship when there are multiple points of contact, so that if someone does leave, the client still has an anchor with the business. Also, multiple people interacting with the client are probably going to provide better levels of service than just one person, because you're adding expertise as you do this. And finally, last one on the page here, and this gets back to everything we've been talking about so far, where business owner knows the business's value, knows their exit options, and continually adjusts the business to find the optimal exit option. That's worth way more, way more than someone who will just say it'll happen one day. Okay, it's a process. It's something that needs to be worked on. Okay, so now we're going to start talking about the various ways you can transition a business. And again, everything we're talking about here today is a 30,000-foot view. So we're not going to dig too deep here, but just to give you a flavor for the options that are available there. And the first ones we're going to talk about are going to be on the family side. Now, so these are businesses wherein the idea going in is to transition the ownership to a or more family members. I will tell you up front, a lot of people think that they're going to transition to family. It turns out that a lot of the transitions that happen to family don't occur. They end up being sales to someone else for a lot of different reasons. So it's really, really important, if you're planning on transitioning to family, that you get family in the right frame of mind and the right training in the business. So some of the things to consider when you're transitioning to family, you can see, and we've got on the screen here a bunch of things. Ownership versus management. Yeah, there's a difference. Okay, it's different mindset as you're walking in the building, whether I'm just managing or owning today. An ideal setup, and this is just from years of experience talking about this, where you have family members who are active owners and you have inactive family members, passive owners. It's really, really tough to have family members who do the day-to-day and are pouring their heart and soul into the business. And then once a quarter, the rest of the family members are dialing up saying, hey, when's the distribution and how much? If you're going to run a business, you need a dedicated chain of command, and you need the ability to run the business to the business's needs, not necessarily to a bunch of people that are expecting a distribution. That's tough. So things to talk about there with the current owner, what's the right way to set it up? You need to set up rights and obligations among the owners. Again, if you've got people who own a large block of the business but aren't really contributing to it, but again, they're expecting a payout and they're getting voices in terms of board meetings and whatnot, is that the right way to really develop the business? Depends. What are your company values? What is the company culture? Those are things that can get lost in a transition. And if you lose them, it takes forever to build up something that's going to replace it. And it probably won't be as good because you've spent a long time getting to that point. So make sure that everybody's on board with that. Again, to reiterate the point again, the company is a business. It's not just a source of income for everybody and their brother. It's got to be managed as a business. If you're going to have family in the business, I've got it in quotes there, prereqs, okay? What has to happen before you join? Do you have to have some level of education? Do you have to have outside work experience? And there's a lot of other things that could go in here. It's important to have, and you can take this with the next part here too, where there's a written plan for working in the company. I'm a huge fan of this, so that everybody's on the same page. Here are the things that you, family member, are going to have to do to A, get in the business, and B, work in the business. And here it is in writing, and we're going to stick to this. And that makes it a lot easier for people to really decide up front, is this something I want to do with my life? Here's what's going to be expected of me. And everybody can see that you're being treated fairly. And again, there's a lot of things on here. You can see that, start on the loading dock, not the corner office. That's setting expectations. It also sends a clear message to the rest of the workers in the company that you're going to earn it if you're coming in the business. And more importantly, to pick up the cross training, which is going to help with management later on, you want to rotate through functional areas and get experience and feel for everything in the business. If your family person is great at sales, awesome. But someone who ends up being great at sales may not know a thing about operations, and then you end up having a disconnect when they're sitting in a bigger chair. Finally, if you're the owner today, what is going to set the right tone for the business, plus what is going to take care of you and your spouse and the non-participating members of the family? Is it a gift or a sale? I mean, a gift sounds easy. There are a lot of things that go along with it, not the least of which is the psychology going along here. If there's an expectation that I'm just going to get the business one day, does that take me down a different path in terms of how I'm going to run my affairs versus if I have to put my sweat equity in and actually pay for it in some fashion? And again, part of the things we're going to work with business owners, it's budgeting. Saying I'm going to not be involved in the business anymore and I'm going to take my winnings off the table. Well, what are those winnings and what are your expectations and needs for your own retirement with that? So there's a lot of things that go in when you're transferring to family, and there's a lot of setup that has to happen beforehand and a lot of work that happens along the way to make sure that you end up with family in the business who not only are dedicated to the business, but are trained to run it properly. It's a lot of work. So common methods for transitioning to family: you can make an outright gift. You can sell the business for fair value or a discount, and it really depends what makes sense to you and what your cash needs are. There are loans that can be created and they can be forgiven or not forgiven. If you've got a couple children and let's say 2 are going to be in the business and a couple others are not, well, how do I equalize the estate? And when I say equalize the estate, and I say equalizing gifts on here, I think the real important way that we start talking about estate planning with our business owners is fair does not mean equal to the penny. It's entirely okay with a lot of business owners that if there are children in the business that they may end up with quote unquote more based on the value of the business than children who are not in the business. That's okay because they're not going to be able to just cash in and do whatever they want with the business. They have to run it and they're putting their heart and soul into it. But fair can come in a lot of other forms and be taken care of without disadvantaging the business. So I've got a list on here of other things that can happen regarding the transfer of the business. There are various trust vehicles which can not only take care of the business ownership, but provide asset protection and maybe some tax benefits too. You can see them on there. And there are also good reasons to consider making transfers during life as opposed to death. There are tax reasons, excuse me. And there's also the ability to show ownership while you're alive and see how they're doing with it. So there are a lot of things going on in a family transition which are important to take in mind and work through. So it's a little bit of work. It's a lot of bit of reward once you're at the end of it though. All right, so moving away from family, let's talk about first employees and partners here. Okay, so what do we mean by that? Well, a lot of businesses end up being sold to the employees in one form or another, or other partners. So talking to sales of employees, I'm willing to bet most of you have heard the term ESOP. Okay, an ESOP is a way wherein the employees of the corporation end up owning the corporation, not directly, they own it through a trust. What do we mean by trust? There is a trust that is set up, it has a trustee. The trustee is the technical owner of the shares, and each employee of the company has an account that gets allocated shares based on basically their salaries, but for, there might be some other things in there too. So the first question we're always asked is, okay, with ESOPs, so that means all the employees make the decisions, okay, they run the company. Not true. An ESOP is still structured like a corporation and still run like a business. So there's a board of directors, there are managers that the board hires, there are, if it needs to come to it, force reductions. I mean, there are all kinds of things that happen in an ESOP that look exactly like any other operating business, because that's the goal. This is an operating business. It's not a collective, it's not a feel-good moment by itself, but there are things that happen that you wouldn't, be able to tell that this was an ESOP unless, somebody come out and said, oh yeah, this is an employee owned. So if you have an ESOP, there's a tax deferral available if you have a C corporation. So we've also seen this before too, where first thing comes out of the owner's mouth. Well, I've got an S or I've got an LLC. So maybe, and we've seen it happen, you convert to a C and you wait, an appropriate amount of time. If you sell the corporation into an ESOP and it's a C, you can avoid the capital gain associated with that sale. I do not want to spend the next 4 hours going through all of this with you, but just understand that that is something that is available to owners, and it has a lot of, well, it really perks people up when you talk about it. So it's something to be explored as you move along here, if an ESOP makes sense to you. The ESOP buys a stock with pre-tax dollars. You don't have to do an ESOP and be out of the business. ESOPs often come in tranches. Usually the first tranche comes at 30%, then the next one goes out and gets the trust owning 51%, and then finally thereafter, the ESOP will get to 100%. So there's often a way to start with the ESOP and keep your ownership and keep control, reap some of the benefit, and then just move along. So this is something that you can plan for over a series of years here. Obviously, it can be a great motivational tool for employees. If you talk to somebody who's involved in ESOPs, they will tell you for sure that one of the things that you will often see is a lot of extra employee engagement. Not only that, you will see a lot of employees that are better ready for retirement. And employees that have a good retirement, that has a halo effect on the company. It makes it easier to recruit people in. It makes it easier to keep people satiated while they're working, because they can see that there is something that they are working for when they see that their colleagues are enjoying themselves. There's a lot of superfluous stuff that goes along with an ESOP that it doesn't show up on a spreadsheet. With an ESOP, can they afford it? Can I get the employees to understand what's going on here? Owners have to be willing to share information. I mean, it pretty much becomes an open book at that point. You are now adding in not only the IRS, but the Department of Labor to your sphere if you're an ESOP. So there's a lot of things you have to file here. We've already talked about that the entity type matters. To be fair, final point here, most ESOPs are not going to generate the top dollar that a motivated buyer is going to come in and give you. So an ESOP is not for everyone. I think it's fair to say that most of the people that I've worked with have at least kicked the tire on an ESOP to see if they have any interest, but only maybe 10% tops are really go down the road of taking a look at it. But it makes sense in some cases. All right, so let's leave the general employees behind and talk about sales to managers. Now, you might have heard of this as a buyout or a leveraged buyout. And it happens often, especially where the owner takes a look around and nobody in the family is interested or ready. Okay, well, I've got a management core here. Maybe they would like to come and buy me out here. And there are ways to do this. And it isn't, again, necessarily an all at once kind of thing. But maybe there's a stock bonus program to get equity down to the managers and incentivize them. Sometimes, not often, the managers put their own money in. I take that back. Most managers will end up putting some of their own money in, but most managers don't have nearly enough money to put in. So this is where the borrowing comes in. So most of these transactions are going to be leveraged. And when we talk about leveraged, does that mean that we're borrowing all from a bank, or we're borrowing some from a bank? And am I the owner? Am I holding paper? Meaning, am I getting paid out over time on some kind of installment sale here? So do I have skin in the game when I exit, when I'm selling to my managers? You might. In fact, a lot of the times you are going to see some. So you got advantages with this. Obviously, if your managers see that there's something that they're aiming for in terms of ownership, that's an incentive program. You can also get, with a sale of managers, there's a way to make sure you get capital gain treatment, which is important. I don't want to spend a lot of time on taxes today, but capital gains are generally taxed at a lower rate than ordinary income is. Your managers are, hopefully, if you've got the right managers, more willing to accept some of the risks that go along here because they're motivated and they know what they're doing. At least they think they know what they're doing. And again, most of these are done, especially where the owner is holding some of the paper to get paid out over time. They're done over 5, 6, 7 years, something like that. So it's a way to fund parts of your retirement because basically the managers are going to be paying you out of the earnings of the company. But because the managers are going to be paying you out from the earnings of the company, you have to have the right people not only in the group, but in charge. Because if you're holding paper, the only way you're getting full value out of one of these transitions is to make sure that your managers are the right people. Okay, if for some reason the wrong people get, not only are part of the group, but are in charge, after 3 years on a 6-year payout, you may be having to jump back in to rescue the business and your retirement. Nobody wants that. So you've got to get the right people in charge. And more importantly, you got to figure out is everybody in the right role? And my last point there, I think really rams that home. Good management decisions don't come from the loudest voice in the room. Okay, you will see out of any group of people that there's someone who's leading the charge and running with everything. But if that person is not a strategic thinker, if that person doesn't know how to handle operations or accounting or anything, well, they may not be the right person to be running the business and calling the shots here. So it's really incumbent upon a business owner, if you're going to sell to your managers, to not only have the right managers involved, but have the right managers in charge. Okay. And finally, I know everybody thinks, oh, I've got a buy-sell agreement. So I've already got, if I'm selling to my partners, that's already taken care of. A buy-sell agreement is really more like an insurance program. There's a backstop if something happens. Or you can also think of it as, sort of the starting point of negotiations. Because unless you actually trigger something in the buy-sell, if you're going to sell to partners, you probably want to negotiate a little bit here. So it's really a starting point. Let's talk about it that way. So it's got a value methodology for the business. That may not be what, that may be great, as a backstop, but it may not be what you're looking for to get out of the business. A buy-sell agreement can be self-funded through life insurance. Well, okay, I will tell you the vast majority of buy-sell agreements I look at are two things. Old, because they came into play when the partners got started, so they don't necessarily recognize the value and the complexity of a successful business 15 years down the road. And B, they're underfunded. Because if I have a business that today the numbers say is worth $10 million, and I've got $1 million life insurance policy with some cash value in it, well, that's not really going to pay the freight here in any way, shape, or form. So it takes a lot of effort, again, as part of your good management, good exit strategy, to keep your buy-sell agreement updated for the complexity and value of the business. So keep that in mind. Okay, let's move on to the triggering events here. So when you have a buy-sell agreement, you can see the triggering events here, okay? Take a look here: death, termination, disability, bad acts, divorce. Not, you know, I know I've got retirement on there, but realistically, you know, for the most part, if I want out, I want out, and I want to sell to my partners at a right price, it may not be reflected in my buy-sell agreement, which is one, a good reason to keep your buy-sell agreement updated for the complexities of the business, and two, to kind of work with your partners all along so that there is an exit plan, especially if you've got partners where one is significantly older than the others. I mean, this shouldn't be a surprise when something happens here. There really should be a glide path that is built in, you know, to make for a successful transition on this. So taking a look at your buy-sell agreement, I just want to focus, there's a lot of things on the page here. I want to focus in on the bold. Okay, is there a valuation formula? I've seen a lot of buy-sell agreements that put a price in there, and you know, that's not going to help anybody out. Okay, it needs to be, the valuation formula needs to be dynamic and effective with dealing with future developments, which again is why you keep a close eye on the buy-sell agreement to make sure it's updated regularly for what you've got going on. And then, of course, we already talked a little bit about funding. If you're going to trigger the buy-sell in one form or another, there really has to be funding available. If it's not from a sinking fund like life insurance or something else, well, it's got to come from the company or the other partners, and a lot of times that's not going to be available unless you plan for it. So a lot of things with buy-sells. All right, now we're going to leave the internal, meaning someone in the family or someone in the business, and we're going to look at the external. And you're just basically saying, I've looked at this, you know, and the right thing is to sell. And to that end, we've got a couple ways to take a look at this. If you look on the next slide here, we've got, how it happens. We've got acquisition, meaning someone's going to buy you. That could be a strategic buyer or private equity. Okay, so you've looked at your family, it doesn't work there. You've looked at your managers and your employees, it doesn't work there. So someone's coming in and buying you because, you know, this makes sense to them, either from a purely financial standpoint or because, you know, if you're looking at a competitor or some other player in the industry, what you do fits in really well with what they want to accomplish. Please note here, will likely be an asset sale versus stock sale. Now, there are ways to work around this, but you don't necessarily off the bat get that capital gain treatment if you're going to sell to a third party when they're buying your assets. So that's a consideration on your side because the net to you is probably going to be a little less than the other way. Most acquirers don't want your corporation. They don't want any obligations that are pertinent to it if they can get around it. So they just want to buy your assets and your client list and everything else. You, on the other hand, obviously would like to just sell the whole kit and caboodle. So this is all part of the negotiation strategy when you're going into one of these. Finally, we're going to note here that IPOs are available if you have a really, really successful business and you got a valuation, I'm going to say north of 750 million, but probably more. An IPO is probably available to you. It's something you can talk about with the appropriate bankers to really go and maximize value that way. So what are some other things you need to take a look at when you're talking about selling? And we've got it here, we call it the 4 sale signs because, you know, bankers are funny. So first thing to look at here, your business is worth way more to someone else than to your employees or your family. Okay, in other words, this is the big offer coming in. Someone's looking at you and what you do and figured out a way to, you know, integrate it into what they've got here. So, it's a factor above what you can expect from any other way of transitioning the business. If you're looking at family, but your next generation is not interested, committed, or ready, that's a big sign there. Or if you just don't have any family or employees that are ready to pick up, you know, after you take off here, that's a real big sign. And finally, as we've talked about before here, the business just simply not have the scale for the industry you're in anymore to make a go of it in the future. All right, so take a look at those there, and you know, some of those might apply. But if I am going to sell to a third party here, well, what are some things I need to think about? So first thing, what's my bottom line? What do I need from this business my cash flow in retirement so that I take care of myself and my family. Well, that's one of the things we have to take a look at when we're working with people, cash flow it out, try to back into a number, see if we're there. Terms of the transaction. Terms are more important than price. They are in your general business now with a contract. They certainly are in regards to a sale of the business. Literally, most offers for the business are going to fail because the terms become too onerous or unlikely. So terms are a really, really big thing there. Have you thought of a plan for your future outside of the company? There's plenty of studies out there that owners have regret after they sell because they didn't have their mind set on the next stage. And the next stage isn't just golf and relax all day. Yeah, that's great, but honestly, after a year, studies have shown that about 70% of business owners have at least some regret that they've sold their business. The future requires some effort put into it. Again, maybe you're one of those people who can just lounge around all day and be fine with it, but most people want to have some purpose in their life, and it takes a little work ahead of time to figure out what the next step's going to be so that you're ready for it and you can actually leave the business behind. Obviously, when you're talking about selling the business, we're talking about your family. If you have charitable intentions, there's things that we can do there, but obviously your estate plan needs to be coordinated with that because now you don't have an asset going in there that's probably going to somebody else. You have, let's just call it a glop of cash or stocks and bonds. And that makes a different kind of estate plan from before. And again, if you're going to sell, what else should I be looking at from my personal standpoint in terms of asset protection? Again, getting ready for retirement, having all this cash in stocks and bonds, that's a different setup than having the business. When you're looking to do whatever, we're talking about transitions here. What does that mean in terms of what do I need to do? Well, you need advisors. You need the right advisors. So what do the right advisors look like? You want someone that's going to give you objective advice. You want to get someone who's going to give you the entire picture, the holistic and integrated planning piece here. You want someone who's easy to work with. Now, it's probably likely that there's no one advisor that's going to be able to do this. You're going to need a team. You've got an attorney because there are things that are going to happen on the law side. You need a CPA because there's certainly things that are going to happen on the accounting side. And you need someone to kind of walk you through your personal things and then how everything works out here. So at least those kind of three here. You can see we got on the page here. There's a business team and a personal team. Think of your CPA on the business side here. Okay, what does it look like? What's the business look like? What's the value? How are we set up for a transition? And you might need the legal piece on this side too here. On the personal side, okay, well, if we're going to hold on to the business, what's our family plan? What's our core ethics? How do we run things? Probably don't need the CPA here. Do need the lawyer. You also need lots of other people, to help you out and work through these various things that you see on the screen here, so that you are ready in the right mind frame to, again, run your business properly and have a successful transition. Just so you know, we put the slide on here, PNC. Again, what I do, I work with business owners on their transition planning. There are lots of other people that do it too. There's an umbrella organization out there called the Certified Exit Planning Advisor, or CEPA. Everyone involved in the business transition at PNC has gone through the CEPA training and is registered with them. You can see some of the things on the page here. It helps to have some basis when you're talking about transition and what a transition is and what the options are. And the CEPA really gives us a good grounding in all of this. So I think something like having a CEPA involved is really going to benefit you when you're talking about transition issues. And finally, we're going to talk here, just to give you an idea, there's a lot of things that go into a transition process. And a lot of these things just don't happen. It really is structured. You can see all the stuff that's on there. Again, process is the most important word here. It takes time, it takes effort, But if you put in the time and effort, not only are you going to have a more successful transition, you're probably going to have a more successful business. Because again, transition planning is all about good business planning. All right, so I'm going to kick it back here and see if there are any questions in the queue. Okay.
Hand it over to Nick, who will close things
I
out.
was going to say, I've lulled you all to sleep, so now I'm going to turn it over here to Nick Marquis from our commercial bank, and he's going to have some closing remarks for all of us.
Thank you, Gene. In addition to PNC Bank, I'd like to thank all of our other sponsors, Meyer, Unkovic and Scott LLP, UPS, UPMC Health Plan, AT&T, Ensco Long Insurance Group, Cohen and Company, Wilkie and Associates LLP, Net Experts, and C-Leveled. Also wanted to remind again about the upcoming events, the Success Cadence with Dave Mattson, September 22nd, 8 to 11, Belisar, Canonsburg. Extreme Ownership, How the U.S. Navy SEALs Lead and Win with Flynn Cochran, October 22nd, 7:30 to 10:30, David L. Lawrence Convention Center or virtual. Demystifying Family Business Pressures Leading to Multi-Generational Success with Christina Wing, November 12th, 8 to 11th, Hilton Garden Inn, South Point, to be determined or virtual. Lastly, just would like to point out in my role with corporate banking here at PNC, the two topics that we heard today are obviously very relevant. Obviously, the economic update, that's very important always, as is the estate succession planning. From my side, again, on the corporate bank, I get a lot of questions on this. We're trying to provide information to our clients. So I would offer that if anybody would like to take this a step further, both myself and Gene would be glad to do that with everyone. And then lastly, would like to thank everyone for their time today and wish everyone a great day. Thank you.